Hi, Mikey.
Hello.
Hello, Michael.
Michael, it's very formal.
Yes, I like it. I like the name Michael a lot. I think it sounds good. So I use it when I can. Is that okay with you?
Yeah, that's fine.
Welcome to the Futures Edge podcast. I'm Jim Urio. Welcome to the Futures Edge podcast. I'm Jim Urio. And as always, the executive producer, co-host, brains behind the operation, Bob Iacchino. Today we have our favorite technical analyst, Path Trading Partners senior technical analyst, strategist, Mike Arnold. Thank you for coming, Mike.
Thank you for having me, Jim. And
so
Bob.
we do technicals on the first Friday of every month, but it's also the day of unemployment, which I like to talk a little fundamentals first, if that's cool. First of all, I'd like to acquaint you with the birth-death model of today's unemployment number. Now, Bobby, listen carefully to what I'm going to say, because if I'm full of shit, I want to be told I'm full of shit, because this is what I believe the birth-death model is. It's not a population calculation, which many people think it was. It was just back in the dark ages, the Fed, the BLS realized that they weren't really capturing the entrepreneurial sector of the labor market as well as they should. So they came up with this model that measures small business openings or new business openings juxtaposed against business closings. And they take an average in the past. And with that past, they estimate what how many new jobs that aren't part of the survey are in the calculation. The problem, and the critics of it, me being one, is that oftentimes they don't measure turns in the economy because they're still backward looking at averages. And this particular NFP number, 231,000 additional jobs were added because of the birth-death model. Did I get it all right, you guys?
Yeah. And that's actually a great explanation. I wouldn't have explained it as cleanly as you just did.
I've been working on it all day.
Here's the thing about today's payrolls report, and Mike can vouch for me on this. In our live streams that we do, yesterday I said I thought the number was going to beat. I had it at 215. I didn't have it at 339. So let's get that out there. I wasn't smart. I was lucky. But from that perspective, and I said that stocks would likely rally unless it was outrageous, and gold was likely going to get hit. But neither thing was a final trend break from a perspective of, is that it? Are we fine? Because you still have the wild card of the Fed. And as we dug in deeper to the number, and this goes to what I'm going to get to what you just said, Jimmy, because I think it's important. This goes to when you look at wages, they rose, but they eased, right? The rate of growth of wages eased. Last month's was revised a tenth lower as well. So instead of 0.5, it was 0.4. We had the unemployment rate rise without much of a move on labor force participation rate, and that goes to the birth-death model, right? So you take that in its totality. To me, I think this is one of the last outrageously strong job numbers you're going to see. And we're going to start to see a steady decline on the headline numbers over the next few weeks, starting likely in the August release of the July number. That's what I think. That's why I think this is, and I mentioned this yesterday, Philly Fed President Patrick Harker said, first of all, he doesn't like the word pause. He likes skip. I don't know why pause implies that the next move is going to be an ease any more than skip does. But so let's call it this June, I think will still be a skip. And there was briefly a move in the CME Fed watch tool from pause, hike. It went kind of like this and then back like this, right? And that's because I think that this is, even though Patrick Harker said it, I think he played lip service to data dependency more than anything.
Yeah.
And the Fed members have mentioned, both in private to people we know and in public, that they're kind of hamstrung by the quiet period. That like when data changes during the quiet period, they feel they have a responsibility toward their last statements. We might have seen that in the last rate hike. I think that was one of your theories, Jamie, is that they hiked rates because they felt like they had to.
Yeah.
The last couple of speeches we saw before this jobs number was, this is a skip, but we have to look at the data. I don't think this data was enough to change that pause to a rate hike by any stretch.
Here's why I disagree. Well, no. Why I agree with you. Actually, you tied it up at the end.
You're just so
Because
used to disagreeing.
I'm just so used to disagreeing
Just
with
the
you.
words that
But
came out.
so up to this point, and again, tell me if I'm crazy with this, is that the labor numbers have been the thing that's been stubbornly strong, the thing that really poses a problem, where the inflation numbers have been moderating and come back down, except for that PCE number that we saw last week. But so we have CPI and PPI on the 13th and 14th. I'm not as fearful of those as I was of the unemployment number. Am I crazy of that?
Well, the reason you're crazy is because we bitch and moan about the Fed looking at data that lags. Nothing lags more than employment.
Right. Okay.
Literally of
Yeah.
the entire data set, unless you go to leading indicators, which is usually almost 3 months old by the time we get it. Nothing lags more than the non-farm payroll. I'm sorry, lags more than the non-farm payrolls number. That lags more than anything. So if you're talking about, I heard somebody today, I don't know who it was. I got to start marking this down so I can give people credit. Somebody mentioned today, it might have been on Bloomberg because I don't watch
If you can't think of who to give credit, just give credit to me. Okay, but anyway.
All right. So Jenny Iorio earlier said that, excuse me, and now I lost it. So I'm just going to go fuck myself because I don't remember what it was.
We're starting out wonderfully. Michael, would you like to add anything before we get to the S&P chart, which, by the way, to me, this was my big day, provided we get some follow-through strength on Monday.
I remember.
Bobby's got some. Well, go, Bobby.
I remember that I lost it again. Go ahead. I see early stages of Parkinson's or Alzheimer's or something. Not making light of that. Just saying it's coming.
Mike, are you there still, or did you fall asleep?
I remember. Peak layoffs happened in January, late last year and early this year is what they said. Peak layoffs already happened. Okay. Now, I disagree with that because those layoffs were very tech focused.
Yes.
So if peak layoffs happened,
and it was mean reversion.
Yeah, and if peak layoffs already happened, we have the first soft landing engineered by a central bank ever.
He said with a note of doubt and sarcasm in his voice.
With a note of certainty that that's incorrect. Go ahead.
That is incorrect. Michael, do you want to add anything to the fundamental discussion, or you want to jump right into what I think is big news technically?
You know what? I think we should just get to your big news technically. I have a feeling you were watching for a close above 42.50.
That's been my level. Then I want to see a little bit of follow through on Monday. Am I crazy to think that means a significant rally?
My level still 43.19, 43.20. I need a weekly close above there. That would be very, very significant. Then that would be very significant. That does not mean we necessarily go to new highs. It means the probabilities have shifted where we go, could go materially higher. Now, the NASDAQ did close, it's closing on a weekly basis. The NASDAQ is going to close above its key level of 14,390, but I would just round it to 14,400. So that means two markets, because months ago we had the Dow close above its key level and then it retraced. Now we will have, and it didn't retrace enough to invalidate its close above the key level. So now we have the Dow, the NASDAQ. Then if the S&P closes above there, then we can definitely see some higher price action after a potential pullback, because we've hit overbought again. Things going to be overbought and continue to be overbought. However, for any Elliott Wave fans out there, we have the potential diagonal ending wave 5 coming with the S&P. That doesn't mean we have to go to new lows yet. That means we get to have some kind of pullback. NASDAQ, where it is trading now in reference to its 8-week moving average in relationship to its Bollinger Bands in relation to a 5-period RSI, is incredibly overextended and overbought. So we do have a potential daily topping pattern in there, but that wouldn't even take us back to the prior breakout level at 13,571. So I would not be surprised to see some kind of pullback in the short term, but it gets very interesting if next week the S&P does close above the that what 43, let's just call it 43.20.
And
I
Mike,
like it.
if
Can
we
you-
could, if we go back to
go
the
back.
S&P, Jimmy said he wants to see some follow through. So would you qualify follow through as sort of a pullback to whatever you think is the strong support there, and then a rally back up to make new highs? And Jimmy, would you agree that would be follow through? You don't necessarily need it to go Monday morning higher, right? I'm asking you both.
I was kind of, just be real quick, I was kind of thinking strength above today's high. More than just a cup of coffee. We've all seen fake breaks before, but that's what I meant. I did not mean a pullback necessarily. Mike, what do you think?
Again, I needed to, whether we could trigger, it's all about the key level. So whether we trigger that first and then pull back, or whether we pull back and then I'll watch what I call the secondary reaction. And that strength of, after we get some kind of pullback, the strength of the bounce back move will tell us a lot. And if the strength of that bounce back move, if we don't close above that 43.20 next week, we pull back, then that bounce back move is going to be critical, because then if that fails in front of that 43.20, we could start seeing more of a top area. But that's level has been, I've been talking about that level for months and it has not changed.
Could you,
Mike,
can we
do you
do a
call it
favor?
the secondary reaction because it's the reaction that comes second?
Yeah, it's so at this point, the primary reaction would be a pullback because of how overextended we are. And then the secondary reaction is the bounce back up. And that bounce back up has to bypass key levels, or we start watching for a more significant top to come in.
Here's my question. Could you do me a favor? Will you explain, because some people, are watching the show new, and you picked out 1320. Why? What's your procedure on that?
1320, because with the analysis I've done with a bunch of markets on a weekly close above, we don't use fib retracements, we use harmonics, which are the 12.5% intervals. So 12.5, 25, 37.5. They actually test out better than the fib numbers. But that being said, the probability shift drastically. It's the first major shift area for the markets. So if you see a close above, now I'm going from the highs, the all-time highs back from January 22 to the lows in last October, the 62.5 level. Let me just getting exact. I did a little rounding, but it's like 43.90, 43.1850. I'm just going off 43.20 because it's easy for me to remember in my old age.
Got it.
That shifts. That's the first major shift. Now, what's interesting is people go, well, some people say, well, what about a close above the 50%? What about this? The shift is not major, because anywhere between that 50% and that 50% was roughly back at about 42.38. So anywhere between that 42.38 to that 43.20 is what is considered a major rollover zone, where we could easily have a significant topping pattern. The probabilities again shift. Again, I'm using the weeklies because not just the dailies, the weeklies jump about 5 percentage points higher once you get a weekly close. And then, since the NASDAQ is one of the more error prone, just because does overreactions. But if you get a cluster of these, like the NASDAQ weekly closing above there, the Dow weekly closed already above there, and then the most reliable is the S&P. All right, does it guarantee we have to go higher? No, but you have three markets that have now shifted their probabilities to where we should see higher substantial price action before we see a potential major pullback. Does that take a major pullback off the table? No, but it means the targets, and I'll give the target should we close next week, because I won't be on for a few more weeks, would be 44.81, and that would be the 75% harmonic, which is also by a very key topping area, just so happens from April of 22, And then the next area would be roughly 46.20 to 46.45. 46.45 would then satisfy the highest probability range where you could again see a rollover. So we could see a rollover before making new all-time highs if this rally does continue.
It seemed to me like that 43.20 level happens to correspond with those highs from probably August. Was that part of the calculus too, or no?
No, it just happens to be that way, which, you know what, it's interesting enough because a lot of people would just naturally be watching that level because it's a major swing high before we made those key October lows. So, you know, stuff just happens to line up when you sort of get the rhythm of the market. You know, again, there's no guarantee. We close above these levels and then something happens and we plunge, sure. But when you see things line up like this, you know, I'm still going off the higher probability move, which is based off the 62.5. It just so happens to correspond to that very, very, very significant key high from August.
Awesome. Bobby, what markets you want to move to?
I'm going to jump to something that I don't think Mike sees coming, but I just kind of want basic thoughts on it. It's the KRE is the best example to me, which is the regional bank ETF.
Well, that's interesting. Yeah.
S&P. I just think people might think that the regional banks are out of the woods. And the chart doesn't look like that to me, even after today. Go ahead, Mike. Whatever you see, it doesn't have to be too detailed.
Oh, that's fine because I've already done this on our live streams. Looks like we're gonna close within the weekly rotation zone. So any rally back towards around 46 is still within the bounds for a potential rollover move. So that would not be shocking to see some continued upward price action. And based off, we've been sort of talking harmonics this one, there is a major prior retracement harmonic at 46.59, a major prior current retracement harmonic that's based off the highs from January to the lows in May, coming in right about 46, and the top of the weekly rotation zones coming in around 47.50. So anywhere up in there, I'd be watching for another potential downwards rollover in the regional banking sector if it can remain that strong.
Bobby, can I ask you a fundamental question real quick?
Yeah.
Are you bringing that up because deep down you believe that there's more cockroaches out there and that these deposit flight is happening, et cetera?
I have to admit, some of the people, including Hugh Hendry last week, really have me convinced that you can't have that sort of a rate hike. 500 could be 550 basis points before it's over, 575 basis points, and not have more go wrong than we've had go wrong. Because, you know, again, you and I've talked about it repeatedly. The only argument, Jim, that you and I've ever had is if the Fed should care if they break something. We both agreed the Fed would hike till they break something. And man, I'll tell you, if you call SVB and Signature as that's the break, doesn't seem like enough to me. Also, you know, they're not really, I have a friend of mine who was in funding. You both actually know him. Mike, you've met him, and Jim, you would know who he is. And he's been sort of semi-retired for a while now, but he takes great interest in this because he was in major bank funding his whole 30-year career. And he is constantly looking at call sheets of banks, and he's like, there's so much they're not even talking about yet. It's not just about deposit flight. It's about bad loans and real estate portfolios, especially commercial real estate portfolios and things like that, that they may not necessarily go out of business, but you certainly don't want their stocks. And a lot of that, I mean, you look at this particular ETF and you put it next to the NASDAQ or hell, even the S&P or even the Dow, this is way worse off. It's not stable yet. So if there's any underlying weakness at all, I think it may be driven from this. This may be one of the sort of, it's not a canary anymore. This thing is deep in the coal mine, so it's not going to warn anybody. But that's why I wanted Mike to look at it technically. I hadn't done that.
Right. I had an ETF idea, by the way, too, because I made money shorting that beer company a couple
Mhm.
weeks ago. That when, and I
Mhm.
don't talk about stocks. I am not licensed to recommend stocks. I'm licensed for futures. Here's my ETF idea, Bobby. I want you to work on it. We can make a shit ton. Any one of these companies, the beer company, the retailer, the outerwear company, any one of them that embraces too much this culture that it seems like a lot of people don't want to hear about anymore, we short the shit out of them. Thoughts
Do a double short ETF.
of those companies?
What would this ticker symbol be if we called it still sleeping? In other
Yes,
words,
or
we ain't woke.
unwoke of some sort.
We
Right.
ain't woke
We'll
yet.
figure this
Still
out. And by
sleeping.
the way, we've already trademarked this, people. So don't start
Yeah,
working on
I
it
mean,
already. Okay.
I got the documents right here. They look
Right
small.
here. I just signed them.
Just
I
sign them. You guys are done.
electrically signed them. Okay.
Hey,
What are we on to?
speaking of ETFs, well, we're on that real quick. Have any of you looked at, have either of you looked at the ratio of the Qs to the IYM, which is the ratio of the NASDAQ to the Russell?
No. Is that the highest ever?
Yeah, it's the highest ever. It prior top was in 20, and the prior top before that was in 2000, and now we've broken out. So either the
Wow.
Russell has to play a crap load of catch up, or the NASDAQ's in nosebleed territory. Not saying it can't go higher. Look, it's above key support right now. However, from a pair trading instrument, like if we start to see some major selling in the NASDAQ, it could be an interesting pair trade idea, because it can stay up here, but longer term we'll probably see some kind of mean reversion, at least to sane levels between the NASDAQ and the Russell.
What's weird about this chart to me, Mike, is a pretty upward sloping mean. So I mean,
For a long time.
yeah, it's just kind of been like this for a long time on the mean.
Yeah, but I'm not, when I say return to some kind of sanity, we don't even have to return to like, this is a ratio chart. Well, I'm not talking a return to 1-to-1, but we could easily return to like 1.8, 1.7, 1.6 and complete a nice pair trade.
So there's a lot of things that are like that, Jimmy. I mean, you talk about, we had Mike Singleton on, he has Invictus Research, and he showed a chart in his Daily Edge newsletter in the morning of the Johnson Red Book being a 10th away from multi-decade lows. And then he showed an 85% correlation between consumer behavior. Now, the reason I'm saying consumer behavior is I don't remember off the top of my head what he used, whether it was consumer confidence or consumer spending, retail sales. I don't know, but I don't remember, but it was an 85% correlation to consumer behavior, for lack of a better phrase. And it was at 1/10 away from being a multi-decade lows. We have the money supply that you've shown over and over again, Jimmy. We've got Mike, you showed a chart on the live stream the other day. I don't remember what it was. It was another thing that was at multi-decade lows that was pointing to a slowing economy. And it's like the only shoe to drop is jobs. And if they don't drop, we've never seen this before.
So I think you just answered my question, because I was about to ask you, when you see that chart, QQQs to the IWM, to me, that's on itself, it wouldn't be terribly awful economic reflection, except for the fact that the Magnificent Seven is driving that so much, which to me, it seems like an internal defensive mechanism with those 7 companies taking all the air out of the room. This is bad, right? I mean, if small companies, we're saying they don't have opportunities to grow, the established tech stocks do, and we're just going to hide our money in there because there's still 2 trillion. That's what you read this as, right?
Yeah, and I mean, it's bad because obviously all three of us favor the job engine of the economy, which is smaller businesses. We want that supported, not. And again, I'm concerned by the angle that this thing has been on since 2000, where it's just getting harder and harder for small and medium-sized companies to perform. I mean, cash is king right now, and as you mentioned, the Magnificent Seven all generate a lot of cash. Right. So people are, excuse me, either going into money markets or they're going into companies that have boatloads of cash. Right.
I want to add something real quick before we get to the next chart. It's a perfect time to plug our good friend, someone who we adore, Carol Roth. whose book, The War on Small Business, goes into great detail on
Yeah.
this kind of thing and why small businesses having a difficult time, and why. And again, most of the stocks in the IWM are not the small business she's talking about, but it's the same cousin of why they're doing poorly and why Amazon's doing
And
great. What do we go to
the
next?
point about Carol Roth, as Mike maybe changes to either gold, silver, copper, whichever one you want to do, Mike. Carol has a new book called You Will Own Nothing. And it's out there in like pre-reads.
Yeah.
And she's getting ready to do like the press thing for it. And I think we'll have her on to talk about the book. So
Heck
she
yeah.
sends us a copy so we can read it.
You might gonna be a little jealous here, but she told me I was mentioned in the book, and I asked her, should I be consulting my lawyer? And she said no, but she did say I was mentioned in the book, which you're jealous of right now, aren't you?
Yeah, a little. I'll let you know. She sent me a copy, so I'll take a look at it. And let you know
She
where you're
said
at.
she was sending me a copy, then never did. So now I'm jealous.
Well, I
Man,
mean,
you flipped that.
you're
That was like a
jealous, aren't
wrestling
you?
move.
You're a little jealous, aren't you?
Yes, now I am. Yes. Where are we at?
We have gold. Gold.
What do you
on.
see?
What do I see? Well, it took a while. I talked about this for a long time. I said I was watching for a gold pullback. Now, this is an example of a primary versus secondary reaction. So gold, we had the major pullback from the highs in May to the most recent swing lows at the end of May. This was the primary reaction going up. The secondary reaction is coming back down. This reaction is going to tell us a lot. As long as we do not close below roughly about 1914, 1915 area, we should be trying to put in a more significant gold bottom. However, and I'm watching for a more significant gold bottom in this area, whether it happens to be a double bottom, whether it happens to be a divergent bottom, something. However, if we do close below that magic 62.5, which is technically 1913.8, then we could see the probabilities would shift for a continuing pullback in gold, and the levels would be 1879 and then 1845. And 1845 would be the highest probability area for the pullback, which is virtually where the 200 simple moving average is again. Now, though that bigger pullback is not on the table until it closed below that 1913 area on a weekly basis.
But so to put a finer point on what you said, you think a relatively significant probability is that somewhere in there creates a double bottom and then could move higher from there. You're saying if it closes below that, that negates it all, but you think there's a high probability that it creates a bottom in there.
Correct. Based off of some longer term analysis of some Elliott wave stuff, I'm not going to go into the details, that there is a decent probability that we do not break that 1913 level. However, if we do, I am not watching for a bottom anymore right there. I'm watching for a more sustained pullback. And when I say bottom, we could be making a multi-week to multi-month bottom as long as we don't break that 1913. If we break that 1913, we will still have the potential for a multi-week / multi-month bottom, but the pullback could be a lot more severe.
And oh shit, I just had a question, forgot what it was. Bobby, you're up.
Yeah, I don't want that to happen. So, because I'm still on gold, but let's go to, unless Jim, you think your question was about gold, let's go to crude oil, because I want to give some background as Mike pulls a crude oil chart up. About a week or so ago, Saudi energy minister, Prince Abdulaziz bin Salman, sort of directed his ire at speculators. And I love this. I'm paraphrasing more than quoting, but I'm using specific language he used. He said he can't get rid of speculators, but he certainly can warn them, even though he's not going to show his hand. He said they will ouch. He goes, they ouched in April. Okay, they ouched in April and they will ouch again. That's all I will say to them, right? So we've got a, now again, second language. I don't think he was trying to be cute or catchy. It's not his first language, but I just loved it. And I use it all the time now. My wife put green pepper on pizza the other day, and I said, "You're going to ouch if you do that again." Damn abomination on pizza. But when you look at what happened in April, I don't know. We had a big gap up and then we just collapsed. And I'm not sure, other than the shorts who got stopped out by that gap up, they didn't really ouch much. So analysts don't think there'll be a a production cut June 4th. Nobody seems to think it. We don't
Is
even
it
know the surprise cut in April started in May, and we don't even have compliance figures on that cut yet. And it's
sure?
kind of been OPEC's way to see who's complying before they decided what they wanted to do. So I don't know. I mean, Jimmy, do you think they're going to do anything? And then
So,
Mike,
but here's my question to
go
you:
ahead.
is part of the weakness we've seen the fact that they're still talking about production cuts, but Russia, Novak or whatever his name is, just came out and said, "No, no, we're not doing any of this bullshit production
Yeah.
cut," implying that they might flood the market. Yes.
Well, yeah, and they have to. I mean, they have to finance the war, and the lower the prices go, the more they need to pump out there. They have a limited market because of sanctions, but it's a big market. It's India and Asia, so it's pretty big. I mean, though they take all comers. Whatever you want to sell them, they'll buy. Um, so it's a pretty big market. They can add another 2 million barrels, maybe, and then they're just kind of halted by equipment capacity. So this is one of the things we said. We said that none of this was going to work against Russia, whether it was price curves or any of that, and it hasn't.
That's what I was just about to say that. And you've been, and Michael, get to you as soon as I say this. Bobby, you've been on this the whole entire time. All these bullshit embargoes, whatever, all
It
it
work.
does is direct the piping of the gold. I mean, there's still the same amount of oil. It's just going to
Yep.
cost a shit ton more to get it to different places until the supply chains adjust. So it's
Yep.
nonsense. But Michael, what do you see here?
Here's this is a good example, since the theme sort of this podcast is the harmonics. When we had the pullback from the highs in April to the lows at the beginning of May. Now you see the 50% harmonics 73.60 roughly, the 62 is 76.07. We pulled up to the 50%, pulled back, went slightly above the 50%, right to the 50-day exponential moving average, pulled back. Any return to 73.60 to 76.07 is still fine. It's technically still in just a major consolidation pattern. The key line, the sand, 76.07. Close above 76.07. Then the next major target clusters are 78.46 to about 79.60. So anywhere up until we close above 76.07 it's still in a consolidation back and forth pattern. And really the close, what's so fascinating, the close on May 2nd was 71.54. We're now at June 2nd. We're 71.98. So we've virtually gone a whole lot of nowhere in the last 30 days.
So the 70 level to me seems really significant. Why? Or am I crazy?
You're gonna have to ask Bob the why, because I just look at the numbers. I have no idea why between
Well, I wonder
70.
if there was some mystery technical stuff that was saying why 70 is. Because I have a theory, of course. I always have a theory, but I want to hear
What's your
Bob's
theory?
theory on it.
Let's
My
hear your
theory is
theory.
that that was the level that the government said they'd restock at. Anytime everyone's looking for when they're going to start pulling the trigger. This is for people who are listening. The bullshit thing that the government did to sell the SPR to drive the price of gas down prior to election. I don't think there's anyone who takes the other side of that debate. But they've sucked down the SPR quite a bit, and they keep threatening that at some point in time we got to refill it. And they mentioned that 70 level. Bobby, do you think that's significant or no?
So they put out a request recently for bids. I don't remember the price on it, but it was a very small amount of crude oil, somewhere in the range of 20 million barrels or something.
And they were going to sell, or they were going to buy?
No, they were going to start to refill.
Oh, okay. Yeah.
When I say bids, I mean, the companies have to buy it and then they sell it to the U.S. government.
That's where I was confused. Okay, got it. Yeah.
So you gotta have the middleman in there. So, they requested, it's only 20 million barrels, and they've got to refill somewhere in the neighborhood of 200 million barrels. So it's quite, actually, just to be at bare minimum of where we should be. And this is the thing I continue. I mean, this may be a little hyperbole, but we're closer to World War than we were prior to the Ukraine and Russia going to war,
Clearly.
and China taking Russia's side, and us taking these strong stances with Nancy Pelosi going to Taiwan, and then somebody on the right did it too, but I don't remember who. So I'm not picking on a party there. We're closer to world war than ever, and our SPR is empty. And I just
Doesn't make any sense.
Yeah, I mean, pricing or not, I don't know. Now, the time to do it would not be now because we had a weak Memorial Day driving season. It was one of the weakest ones in the last decade. People didn't drive anywhere. Doesn't mean they didn't fly somewhere. They just didn't go anywhere. And I think that might be because they've been traveling since COVID, right? Since travel restrictions began to be lifted all the way on to full travel restrictions being lifted, people have been traveling. They might have taken Memorial Day just to relax, or they might have already been somewhere. But whatever, it was weak. And then we had a 12 million barrel draw. Then we had a 4.5 million barrel build. And it's almost difficult to read anything into it on a week-to-week basis anymore. What I do know is that China rebound is not there. Their last PMI numbers were awful. One of the things people leave out of the crude oil specific and the energy in general conversation is that if global manufacturing is in a recession, energy prices go down because factories don't operate as long, machines don't operate as long. There's not enough coal, there's not as much coal being burnt by factories, et cetera, electricity. And China's manufacturing PMIs early last week were just dismal. And even the US, who has arguably one of the stronger economies going right now, the manufacturing sector was dismal. Now you say, well, the US it was weaker than last month. It wasn't dismal. It's 48. It was still in contraction, and it was a tenth lower than last month. Now you say, well, the US doesn't have a manufacturing economy. You're right. The US is 80% services, right? But you go to the most service-heavy economies in the EU, and they're 10 points less services than the US is. Germany and France are somewhere in the range of 70% each. Then you start to go Italy and all these other countries, they're tourism, they don't have any manufacturing. And they're still not as big a percentage services as everything else in the country. So the weakness in demand is a very real thing. So when I bring up OPEC, they are the marginal producer now. They do control prices to a point. They can't control prices while Russia is just pouring out as much as they can. But once Russia reaches capacity, then they kind of do. We're just not there yet.
Interesting.
Can
Michael,
I jump in real quick?
Absolutely.
Just on a longer term view with crude, because we are in either choppy to slightly bullish mode. I say ever so slightly bullish mode until I have a weekly chart up of crude. You can see we've tested the 200 simple, which is the red line. We've tested it back in the middle of March a couple of times. We tested it in the lows at the beginning of May, and we tested it with the most recent lows from this week. We have not been able to close below it on a weekly basis. If we do close below that, and the key level I'm going off is actually the close on from the week of March 13th. That weekly close is right around 66.50. If we get a weekly close below 66.50, I shift to overall more drastically bearish mode. The last time we really closed below that,
Don't point to it. Don't do it.
What?
Go ahead.
Negative.
Well, the last time we closed below, I'm not saying we're going negative again, but crude, when it tends to really get a solid close, and that solid close would also be below the lowest close for March. Not saying this will ever happen, but if we do, my radar goes up that we could get a much more significant pullback in crude. Until that happens, I got to err on the side to that choppy to slightly bullish price action.
That makes sense. Yeah. What next?
How about 10-year futures?
Yield
10
or
year.
just regular?
Doesn't matter, whichever one you want to do. Maybe people understand yield more.
I think people
we're
understand
going
yield
lower
better. That's why I
yield,
say.
so let's do yield.
All right. Well, nice strong bounce up in yield today after we broke out on a yield basis back on the 18th of May, rallying up. We actually closed above the 62.5 from a yield basis. We got a pullback to the prior breakout area, and today we're going to get a rotation zone week daily buy and a percent B daily buy. So I am watching for follow through to the upside, but on a yield basis, I need a daily close back above 373. And then I will be watching for a return to at least 380 to 385, 3.8 to 3.85, if not a break higher.
Wow.
That's, by the way, the pattern you're seeing right there. That's a beauty, right? I mean, that's what you dream about. It breaks out, it comes back, tests that level to validate it, and then shoots higher, right? Isn't that clean?
It's clean, and now we get, this is, again, the pullback would have been the primary reaction was this pullback. Okay, we broke out, we got the primary reaction, now we're getting the secondary reaction. So this is going to tell me a lot. Right now, we're going to close today between the 50 and the 62.5. If we don't get any follow through next week, then I focus on the low close from Thursday, June 1st, because if we break that, then the pattern is broken. Then this most likely resistance, which was retested as support, will be broken on a key closing basis. And then I would expect a bigger pullback in yield. But this is where the secondary reaction, which I've talked about multiple times with multiple markets, is going to tell us potentially the next key levels for the yield on the 10-year.
Bobby?
Yeah, I want to point something out with this chart on the screen. So, Jim, you're right. I mean, this is very clean, right? It's exactly the way you would want to see this play out. So what a lot of people would tend to do, people who are active traders and aren't, I don't want to say aren't disciplined, but don't really, they think they have a plan and they don't, is they would tend to put on more risk, a larger trade, because it's so clean. And I know I can speak for Mike with this because Mike and I have had a million conversations about this. This part, I'm not speaking for Mike. Every trade I do has the same amount of percentage risk versus my total capital available for risk assets. Same percentage all the time. So if I go on a losing streak, my position size shrinks. If I go on a winning streak, my position size increases. But either way, the risk on a percentage basis is always the same. And you look at something like this and you go, wow, this is clean. And the temptation is I'm gonna put on a bigger trade. This is so clean. And then it doesn't work, because even a clean pattern is not 100% probable pattern. So I just want to warn people that when you see something clean, it isn't an indication to put on a double the size or triple the size in most cases. I would also throw out that if you do that and the trade goes to profit, it's one of the worst things that can happen to you because you just got rewarded for bad behavior. We have all grown up with people that used to get rewarded for bad behavior, and most of them are in jail or dead. So just be real careful about trying to do something where you say, this pattern's just pretty, I'm tripling up. And then you come back a week with that, markets are rigged.
Yeah, we love that. Yeah, markets are rigged.
Because
I'm not saying they're not, but they,
to your point, if we knew, let's just say there's a 70% probability, okay, based off these patterns triggering, there's a 70% probability it's going higher. Well, there's still 30% that it's not going to go higher. And I don't know which 3 out of 10 those are. If I did, it'd be a lot easier. We wouldn't have those ouch moments.
You wouldn't be ouched.
I wouldn't be ouching. I don't know. There's
I'm gonna
90%
till the day I die,
probability.
I'm gonna use that ouching thing.
It's
I
great,
love it.
isn't it?
Yes, it is great.
So Jim, you just pantomimed Russian roulette. Let's take the same example of saying this is an example where in a 6-chamber revolver you only have 1 bullet, or maybe the other one's in a 6-chamber revolver you have 2. Does that mean you're going to put it to your kid's head instead of yourself because it's a bigger risk? You still won't do it.
No doubt about it. Right.
It's just people have to be. I'm just trying to stress consistency. This is a beautiful chart for a continued move higher. Let's see next week.
Yeah. Stay in your lane. Yeah. Stay in your risk lane. What else you got?
This is all I wanted to see covered. We got that regional bank out of the way.
Let's do copper before we go though.
Yep, copper.
Oh, and you were about to hit on Apple too. So let's do copper and Apple. We'll just do them quick.
I actually have Apple. I have you said the Magnificent Seven. I have my own 5 index. I want to touch on that. So let's do copper first though.
Go.
Okay, good.
You still on copper?
I'm still on copper. That was,
Okay.
again, that wasn't a trade necessarily. That was, I believe, copper for the next 5 or 10 years. I have not gotten out of anything, not one contract. I believe in the story for copper. It's not really in my trading account. But anyway, go on.
Copper, we need to find, from my perspective, it has to get a serious bounce back. Remember, I talked months, I think this was last, even October, where I said it had to close above 432 for a continued move higher. We never got the close above 432. We did not. We topped out between the 50 and the 62.5. It tried to break above there, never closed above there. Then we've had the rollover play. Until at this point, until we can get at least a close above about 405, I can't get in overly bullish mode. And the first warning signs is about 394 that we could be approaching that. But other than that, we're still below the significant breakdown zone. And any rallies even slightly above where we were this week. And where do we top out today? We topped out today at 378, almost 379. We are still watching for rollover plays. We have not put in a significant bottoming pattern. We did come off some divergences with waning momentum on the last push down to 355, but we don't have a multi-week bottoming pattern yet.
Okay. Doesn't make me feel good, but thanks.
But we don't have to go lower. I mean, we could still trade back down that 355. I'm not saying there's any major bearish signs just yet. There's major support down between this 350 and 355. So, but would I be surprised to see a rollover play to test it? No, not at all.
Gotcha. It was intrigued by the 5 stock index you have, or tell me more. What is it?
I've been doing this for a while now. This is, and then I started hearing about the last, couple of weeks of Magnificent Seven, but we've been tracking Apple, Microsoft, Amazon, Google, and Nvidia for, oh boy, a few months now. Funny enough, we got the close above that key 62.5 level back on the 11th of May. And then the major target was this 1120. These are all equal weighted, by the way. It's just 1129 was the minimum key target to 1197, which is a major topping area, which was the high area from back in November of 21. We've returned to that area and also have a potential double top. I stress potential. It has not triggered. And even if it does trigger, you see here the last major breakout zone by the 75% harmonic, it would only be for a potential return to the high area from mid-May. But we are starting with the NASDAQ incredibly overbought. Because whether you're watching 7 stocks or 5 stocks, they're really leading this chart. The breadth is very narrow. So when I see a potential, at least short-term topping pattern in the 5/7 stocks, I'm going to take notice. Now, we could wake up next week and we could bypass 1197, and that pattern could be off the table without ever triggering. But it has my spidey sense up because that would then be for the primary pullback. And as I started off with the show, then we'd be watching how the secondary reaction occurs, not only in the NASDAQ after we get a primary pullback, but also in the Amazing Five, Magnificent Seven, whatever basket you want to watch.
Fantastic.
It's interesting. Yeah, we can do that. Yeah, that could be ours. We'll trademark that as well. Second thing we're trademarking today.
We created
Oh,
two
Bobby, I
ETFs
ran
today,
into a
and we
guy.
learned about secondary moves.
Yes, I ran into a guy in my health club today. A guy by the name of Mike Boss, been in the business a long time. He goes, I
I know
love
Mike.
your podcast. You know, Mike, I love your podcast. He goes, I think when you look at the picture, it's kind of funny because it looks like Bobby's nose is pushed one way and your nose is pushed the other. And he goes, it's like it balances out or something. So I flipped him off and walked away. But I thought it was funny as hell.
I was going to say, I know Mike Boss. I like Mike Boss, but I'm going to leave that
I do
second
too.
part out.
Yeah, no, right. I was laughing. I was laughing the whole time.
Yeah, Mike's a good guy. He's
Yeah,
a really good
good
guy.
guy. Good. I'm worried that there's a carpenter's about 10 feet behind me who might start pounding nails. I just heard, did you hear about a hammer going a second ago? So
No,
I might sign off.
I've got a Florida storm going on behind me. So I've got thunder, and actually I'm surprised I'm still here. The power
Okay.
generally goes out for at least 5 minutes every storm. Let me
Oh, that's a
rephrase
bummer.
that. At least 5 seconds every storm. But when that
Okay.
happens, the computer shuts down, the internet resets. So I'm glad
Oh,
we
yeah.
got through this.
Right. Anything else, or are we good to go, Michael?
We are good to go. Thank you.
Thank you, guys. That was fun. Have a great weekend, you guys.
All right, see you guys.
All right.
See ya.
Thanks. Bye.